All right, hey y'all. Happy to have y'all back. It's November 25th already. It flies by. It really does. I'm telling you, once you get into November, it cruises and it's cruising. We're almost there, y'all. Today we're going to talk about long-term liabilities. These are bank loans that the company takes out. The company will also issue stocks and bonds, and they'll take out loans. These are the way the company finances their operations through liabilities. That's what long-term liabilities are all about. They also include things like funding pension programs, retirement benefits, and other long-term aspects of liabilities. And as you recall, liabilities are what the company owes to someone else, and long term meaning greater than 1 year. So that's what we're going to talk about today. And then next week, on Thursday, December the 4th, we will talk about investments and the statement of cash flows. Two very, very short discussions. It's actually two chapters rolled in, but it'll be pretty easy, pretty straightforward. So that's why I lumped those two together. So okay, let's jump into our conversation this week. And just a reminder for this Sunday night, I know that we are in Thanksgiving mode at the moment, but for this Sunday night, we have just the Chapter 14 quiz to take care of. Um, and also if you would like to, you're more than welcome to work ahead of time. I always encourage you to because that way you don't get stressed out at the end of the semester with so many things being due at the same time. So please take some time and feel free to work at it if you'd like to. But that's what we got going on for this week. So let's go ahead and jump into our discussion on long-term liabilities. And we're going to talk a lot about how these loans uh, really are calculated, how interest is calculated. We're going to talk about bonds. We're going to talk about how the bonds work. But they work very pretty similar to loans. Um, and we'll talk very briefly about retirement plans that companies oftentimes have to fund on the long-term scale. Those are the type of things we're going to talk about today. So let's go ahead and jump into this conversation. So first, I'd like to talk about bonds. As I mentioned, that they're relatively similar to the way the loans work, and that the company will issue a bond or sell a bond on the bond exchange to investors, and those investors they purchase the bond from the company. The company repays the investor the interest and the face value of the bond at its maturity date. So very, very similar to the way that a long-term loan works. So let's talk about that. So bonds, again, very similar to the way loans work. They have a face value, they have interest rate. The face value of a bond is also called a par value of a bond, and this is the face value. The it, so the way that it works is that the company will sell a bond to a bond holder, which is typically an investor, and they'll sell the bond either through a bond exchange, which is very similar to a stock exchange, or they can sell it directly to investors. Okay. So the company receives the cash from the investor or the bondholder for the face value, which is also known as the par value. And that bond is issued at a certain date, and the company receives the cash on a certain date. And then over time, over the life of the bond, which is typically multiple years, the company pays the investor interest payments during those multiple years. And then at the end of the bond, which is called the maturity date, is when the investor will receive the face value or the par value back. That's how bonds work. Once again, very, very similar to the way that a lot of bank loans work. So, to calculate that interest payment that the bondholder receives, we take the face value, also known as the par value of the bond. We multiply that by the interest rate, and then we multiply that by time. So again, it works the same way or similar way that a loan works. So face value times interest times time. Yeah, that's how interest is calculated. And the time could be expressed in terms of, number of days, months, or years. So, couple of advantages of bond financing. They don't affect any ownership control. So just because you hold a bond doesn't mean you're an owner of the company. It doesn't work the same way that stock does. It works different. Yeah, a bond holder is basically a financier of the company, but they don't own the company. So there's no ownership control there. The interest rate is tax deductible. So that's cool, right? So the company is able to deduct the interest payments in the company's taxes. So that's really cool. The bondholder, on the other hand, that interest to the bondholder is considered income, so they get taxed on that. Uh, the the good thing about bonds is that it can increase the return on equity ratio, which is really attractive for companies to attract new investors. So those are all advantages for a company issuing bonds. The disadvantages are that the company has to pay periodic interest payments over the life of the bond. And then, of course, they have to repay the bond face value or par value when the bond matures. So at the end of the life of the bond. And also, this, of course, reduces return on equity because, it reduces the cash, it reduces on the interest side, the payment of the interest. So, oh yeah, it has a negative effect on equity because it also ultimately reduces net income through the interest expense payments. So here we see an example where there are three uh, options for financing. The company is looking to expand, uh, and so here are the opportunities for the company to expand. Option A is don't expand. We just stay as we are. Option B is through equity financing, meaning issuing stock. And option C is bond financing, so issuing a bond. So I want you to see what the overall effect here is. Options A and B, well, there's no interest involved there. No expansion, obviously no interest. If the company's issuing stock, there's no interest in stock. Okay. And through bond, yeah, well, there's interest payments involved here. So company pays the interest payments. They receive the bond financing, 225 mil. They pay out 50 mil in interest expense. That's going to obviously reduce um, the net income down to 175. Uh, and so in the case of return on equity, we got 175 divided by the 1,000 in equity times 100, we're looking at 17.5%, which, increases return on equity, which is great, but it can also reduce it depending on what's going on. Yeah. So just wanted to show you that nice, quick, uh, easy example. So this is what a bond looks like. Looks relatively similar to a stock, except the difference here is that this is a bond, not a share of stock. The bond is agreement or contract is called a bond indenture. And this is what you see right here in front of you on the slide is a bond certificate, which shows a couple of key pieces of information, the holder of the bond number, when the bond matures, if it's tax exempt or not, the amount, etc. So, and oftentimes it'll state the interest rate as well. So this is just what a typical bond looks like. Okay. So I had mentioned earlier that bonds can be bought and sold on a bond exchange. So real similar to the way that stock exchanges work, a bond exchange is where individuals like you and I can buy and sell bonds. So here we have an example of IBM, the computer company. They have a bond quote, and it reads from left to right. So the issuer of the bond is IBM. The stated interest rate is 4%. The bond was issued in June 2012. The bond does not mature, meaning the bond ends in 2042. Uh, the uh, the yield rate the yield rate is 5.764%, and it has a current sale price of 80.284%. So, uh, what that implies is that the bond, if we were to purchase this bond, it would be 80.284% times the face value of the bond, and that would be the purchase price. Uh, the payments of interest are made semi-annually, meaning twice per year. It has a fixed coupon rate and is rated on the S&P 500. In this case, it has an A minus rating, which is pretty good. Anything in the A category is typically pretty good for bonds. A B series bond, not as great, and then anything below that we call these junk bonds, and we'll talk more about those. So, we need to understand when the company raises cash through the issuance of bonds, how we account for these bonds in our accounting information system. So I'm going to show you what it looks like when we issue a bond. Now, just like with respect to stock, what we talked about last week, we can issue a bond above its face value, at its face value, or below its face value. So I'm going to show you what it looks like when we the company issues a bond at its face value, also known as par value for a bond. So here we have an example where Nike issues a $100,000 bond at 8% interest. It's a 2-year bond. Uh, and so the date of the issuance of this bond is on December 31, 2027. It will mature December 31, 2029, which is 2 years. And it will pay interest semi-annual on June 30 and December 31 of each year. So that means there will be 4 interest payments in total to the bondholder. If all the bonds are sold at their par value, meaning their face value, we would record it like this. We would debit cash for the face value of the bond, in this case 100,000. And we would credit bonds payable, 100,000. And then the note would read sold bond at par value. So very, very simple type of entry. Now, we're going to issue 4 interest payments over the course of the 2 years because we pay them semi-annually. Yeah? And so I'm going to show you how we record the interest. So here we have the first interest payment, June 30, 2028. And The interest rate is 8%. The par value is 100,000, and the length of time is half a year because we pay semi-annually. So half a year, every half a year is every 6 months, basically, semi-annual. You could do point 0.5, you could do 1/2, you could do 6/12, whatever. It's all the same, right? Um, so in this case, half a year, so point 0.5, we can say. Or you can say 6/12 or 1/2. They all equal the same, yeah. And so 100,000 times 8% times half a year, $4,000 interest expense. So we would debit bond interest expense 4,000, credit cash 4,000 to represent the semi-annual payment of interest of $4,000. Again, it works the same way as if it were a bank loan. We calculate interest the same way. Now, at the end of the useful life of the bond, uh, when the bond matures, we need to pay the investor back the par value. And to do that, we debit bonds payable 100,000, we credit cash 100,000. And this is done on the date of maturity. So that's what happens when a bond matures. Now, I just showed you how to do this at what we call par value, which uh, is set by the seller, and par value meaning the face value. Now, uh, bonds can also be bought and sold at what we call a discount rate or a premium rate. Now, just as the name implies, a discount rate means that the stated interest rate or contract rate is below market value or below the market rate. So therefore we say, oh, we are selling the bond at a discount. We're selling it below the market rate. The bond can also be sold above the stated interest rate, and we call that at a premium. So if the stated interest rate on the contract is above the market rate, we say that we're selling the bond at a premium. Uh, so that's that's just the terminology. If we sell the bond at its par value, that means that the contract rate is the same as the market rate. Okay, so those are the terms to remember. So I'd like to show you first what it looks like in an example through a discount on the bond. Now, as I had mentioned, when we sell a bond at a discount, that means that we are selling the bond below the market rate. So the stated value on the bond will have an interest rate below the market interest rate. So here we have the same example, $100,000, but this time it's Fila, which, as you know, is a sports wear brand. So Fila issues a bond at $100,000 par value with a stated interest rate or contract rate of 8% interest to be paid semi-annually, and the bond is has a life of 2 years. It's over those 2 years. We assume that the market interest rate at the time that the bond was issued is 10%. So this implies that we are selling the bond below the market value, which means we're selling it at a discount. So, because of this, the exact issuing price of the bond will be approximately issued at 96.4% of its par value, which was represented by the discounted amount. Uh, so the way that we look at this is we can say that we're looking at the $100,000 and we're discounting it by 2%. We discount it by 2%. That puts us at 96.4% out of 100. You see? So that's how that works. Now, let's look at this a little bit further in our example for FILA and how they record the issuance of this bond at a discount. So we understand that $100,000 times the 96.4% issuance rate is going to give us a receipt of cash of 96,400. So we debit cash 96,400. We debit discount on bonds payable, which is the difference between the $100,000 par value and the amount that we've actually received. So we received 96,400, which is obviously at the 2% discount rate. And the difference is 3,600, which is the discounted amount. So we debit cash 96,400, debit discount on bonds payable 3,600, and credit bonds payable 100,000. Okay. Now what about the interest rate? When it comes to calculating the interest, we calculate the interest uh, based on the carrying value. Okay, based on the carrying value. So what essentially what we do here, what this implies is that we are going to add in the discounted amount to the stated interest payments. Okay, so here's how this works. We're going to calculate the interest the way we normally would on its par value. So we're going to take the $100,000 times the interest rate of 8% times time. That is equivalent of what, $1,000, right? I'm sorry, $4,000. So $4,000, and then we're going to pay that $4,000 a total of 4 times. Because remember, we pay semi-annually, and in this case, it's for 2 years. So that's a total of 4 payments. So we take that $4,000 times 4 payments, and that gives us $16,000 total interest that we would pay before we add in the discounted amount of 3,600, which means the total interest expense on this bond is $19,600. We then divide that by the 4 interest payments to represent a bond interest expense for every payment of interest expense of $4,900 is what we would have issued out. So we debit bond interest expense 4,900. Then we are going to credit the cash, which is the actual amount of interest paid out of $4,000. The difference between the two is going to be the discount on bonds payable. Now, the way we calculate the discount on the bonds payable in this case is we would take the discounted rate, in this case, the 3,600, divided by 4. Okay. Um, and then how we found out the actual amount of cash that was paid out, we took the par value of the bond, which is the 100,000, times the interest rate times time to get us to the 4,000. Okay. And we would record this same payment 4 times: June 30, December 31, and then June 30, December 31. And then because it's a 2-year bond. Okay. So that is how we calculate the interest on a discounted bond. It's a lot simpler than this slide portrays it, because in reality, you're just simply calculating the interest expense that you normally would on its par value. The difference is the discounted amount. So in this case, $900 is the discount amount per payment. It's just going through the steps, really. Okay. Um, the next thing I'd like to talk about is the amortization of bonds, which is oftentimes used in a table, but because we issued the bond at a discounted rate, what we do is we're adding back in the amortized amount each year. I'm sorry, each period for the 4 periods. Because we're making semi-annual interest payments, that means there's 4 of them. And so what we're doing is we're adding back in the amortized amount until we've reached the par value of the bond, which is $100,000 in this case. Okay. That's just through a very simple amortization process. The next part of this conversation brings us to the premium that the company might pay on a bond. And just as you think or imply, that means that we will pay a premium on the bond to the bond holder. So the stated in this case, the stated interest rate is going to be higher than the market interest rate. So therefore, we say it's at a premium. So the calculation here is we have $100,000 times the 102%, or I'm sorry, 100, in this case, 103.6, but times the 102, or I'm sorry, 1.02, which is the difference between the 12 and the 10. So obviously the difference here is ultimately 2%. But so the way that this works is, in this case, Adidas is issuing $100,000 par value. The stated rate is 12% for semi-annual payments, 2 years. The market rate is 10% at the date of issuance. Therefore, the bond selling at a premium. So the issuing price of the bond is stated as 103.6 or 103.6% of its par value. Uh, and I'll show you what that calculation looks like here in a little bit. Um, so $100,000 par cash will be paid to the investor at the end of the bond's useful life of 2 years. And the interest payments will be paid semi-annually of $6,000, which is the face value 100,000 times 12% interest times half a year, or 6 over 12 for zero point 0.5. So when Adidas receives the $103,600 in cash, the bonds that we've issued on December 31, 27, we record it like this. We debit cash 103,600, which is 100,000 times 103.6%. Uh, we credit the premium on the bond payable, which is 3,600, and we credit the bond payable at its par value, 100,000. So this represents the sale of bond at a premium. Now, when we uh, for this calculation on our liabilities on our balance sheet, it'll show the bond payable at 100,000. There's going to be what we call an adjunct account or contra account that adds in the discounted rate or the premium rate 3,600, meaning we're going to have a carrying value of $103,600 on this bond. When we go to pay interest on this bond at a premium, we go through this calculation every 6 months, and it works like this. So we take our interest expense of 24,000, I'm sorry, 20, uh, hmm, something doesn't look, oh, I'm sorry. Yeah. So we take our interest expense of 24,000, which is the face value times the stated interest rate times time, times the four payments. We get to a point of $24,000 or $6,000 per payment, minus the premium, 3,600, gets us to a total bond interest expense of 20,400. We divide that by the number of payments, giving us a bond interest expense per period of 5,100. So we debit bond interest expense 5,100. Then we of course need to calculate the premium on the bond payable for each payment, which in this case is $900. How we got there is we took the 33,600 divided by four payments, giving us 900, which is slightly rounded up. And we credit the cash 6,000, which it reflects the par value, 100,000 times 12% interest times time. And so we make that payment for the four periods, and this is what it would look like on an amortized schedule. At the issuance, 103,600 equals the 100,000 par value plus the 3,600 unamortized premium on the bond payable. During the bond's useful life, we amortize premium, decreasing each period by $900, which is the 3,600 divided by 4. We decrease that by that same amount each period, which brings us back to the $100,000 par value at the end of the bond's useful life. And then, of course, we debit bond payable for the 100,000 and credit cash 100,000 at the end of the bond's useful life. So again, it works very, very similar to what we talked about last week when we talked about when we or was it last week, week before? I forget. I know we talked about uh, other liabilities or long-term liabilities. So anyway, at the end of the bond's useful life, or we say we're retiring the bond, that just simply means that we're repaying its face value at maturity. So regardless of the discount or the premium, we need to retire the bond at maturity. So when the bond matures, we're simply paying out the face value. So we debit bonds payable and credit cash for the 100,000. Now sometimes a bond could be called uh, for when it's repaid before it matures. Now, when this happens, the company ends up saving itself some interest expense if the company decides to repay the bond to the bondholder before the bond matures. We call this retirement before maturity. And the way that this works is uh, if the value of that bond is greater than the retirement price, meaning that the cost of retiring the bond early, it'll be a gain on the retirement of a bond. If the carrying value is below the cost of retiring the bond or paying the bond back, it's called a loss on the bond retirement. Uh, so here we have an example of the $100,000 bond that the company decided, hey, you know what? Let's pay this off early. So we're going to pay the holder off early. We're exercising what we call a call option. It's where there's an option for the bondholder to be paid out early, and it works like this. So we assume it's a $100,000 bond. We've decided to pay it early. So, basically, after the first interest payment, we decided to pay it early. It looks like the bond had a carrying value of 104,500, which includes the premium amount of 4,500 on the bond. And so we are going to pay this off early. And the way that this works is we would debit the bond payable uh, at its par value, 100,000. We're going to debit premium on the bond payable, 4,500, because we bought it at a premium. We're going to credit the gain on a bond retirement, 1,500, and we're going to credit cash 3,000. And what this does is it represents that we're repaying a bond before its maturity date. And it just so happened that this bond was at a premium when it was issued. Okay. So so that is how essentially we account for bonds. Now I'd like to talk a little bit more about notes payable. We've talked very briefly about this in prior weeks, and I want to touch on this again because this is a more common way for companies to raise cash without any type of ownership or without any type of uh, callable type of situation. And that's what we call long-term notes payable, which is really essentially just a long-term loan from a bank. That's a long-term notes payable, long-term note from a bank. And so these loans can also be at a premium or a discount. Uh, and so it's very, very similar in nature when it comes to bonds. And we can see that through this. Company receives cash from the lender. The company repays the lender over time. The repayment is typically and this is where the difference comes in. The difference between a bank loan and a bond is that with a bank loan, we're repaying a portion of the face value plus interest over the life of the loan. Whereas with a bond, we just pay interest until the bond matures. So that's the difference you need to know. So with bonds, We pay interest-only payments until the bond matures. With loans or long-term notes, we pay back a portion of the face value plus interest over the life of the loan. And these loans are typically amortized over time. So, a couple of dates you need to know about is the date that the loan was made, the date that the promissory note was signed, which is called the note date, and the date of maturity, which is when the entire loan needs to be repaid. So, give you a couple of, well, I'll walk through a couple of examples with you. This example is what we call an installment note, which requires a series of payments to the lender. Very, very typical of a business. They have to repay the loan principal plus interest over time. That's how the majority of loans work, as you're probably aware. If you own a house, you own a car, you are familiar with the way that these types of loans work, probably. You're repaying a portion of the principal and the interest expense as well in the same series of payments. So here we have an example where a company has borrowed $60,000 from a bank to purchase equipment. The company signed a loan document for $60,000 face value, an 8% installment note requiring 3 annual payments per year. The payments on installment normally include interest expense and a portion of the principal that has been borrowed. So the first thing that the company does is we debit cash 60,000, credit notes payable 60,000 to reflect the receipt of the loan. 60,000 at 8% interest, that's 3 years. So this requires annual payments uh, of equal payments. So in other words, we're going to pay the same exact amount over the life of the loan for those 3 years. So in this example, we've used what's called an annuity table, which represents a way that we can find the present value of a loan. And so what we do is we go across the top of the chart. We look for the 8% interest rate, and then along the side, we come down, we find 3 years. And then in this case, it brings us to 2.5771 as a factor. We take that 2.5771 uh, as our present value factor. And where am I at? With that 2.5771, we multiply that by the respective dollar amount to find the present value of 60,000. And this implies that we will make 3 equal payments of $23,282. So one payment per year. So at the end of each year, we're going to pay $23,282 of principal plus interest back to the bank to satisfy the loan. So yeah, I'm sorry, to calculate that amount, I don't know why didn't say this earlier. To calculate that 23,282, we're going to take the face value 60,000 and we're going to divide that by the factor, which in this case 2.5771. All right. So when we figured out how much our payments are going to be, We can reflect what's happening with the interest and with the face value of the loan through a very common type of chart, if you will, that represents the amortization of the loan. So we take the beginning balance, uh, we then multiply that by the stated interest rate. We then add in uh, the payment amount minus the interest expense to then get the amount that we would debit to notes payable to equal the amount being paid out. So, relatively complex. This slide makes it much more difficult than it actually is. But this is a very typical amortization of a loan. You can see that over the life of the loan, the amount of interest typically goes down and the amount of principal typically goes up. Okay. Uh, the next part I'd like to show you is the journal entries that we make for those 3 years. And it's based off of that table that I just showed you. So in 2027, our interest expense is 4,800, and the face value, a portion being paid, is 18,482. So it's a total payment of 23,282. In 2028, that interest expense was 3,321. The difference moved to the face value payment. And 2029, the interest expense was only 1,725, and the remainder was from the principal amount. Uh, if you were to add up the 18,042, 19,961, and the 21,557, you would get 60,000. So that's how you know you did it right. So those are the equal payments. Of course, sometimes it's not always equal, but you know, in most cases they are, especially if the interest rate is fixed. Mortgages and car payments work the same way. So if you own your own vehicle or if you own a house, these types of payments work the same exact way. A mortgage is, of course, a legal contract between the mortgage holder, which is you if you own the house, and the bank. What a mortgage does, a mortgage is what I would call a mortgage-backed security, which means that the bank has a right to seize the security in the event of failure to repay the mortgage, which is the indemnification of this agreement, of this contract. It implies that the borrower is required to make the payments to the mortgage holder, the bank, and this is a way of securing the asset. This gives the lender the right to be paid out cash proceeds from the sale of the asset if a contract exists as well. So here we have an example where a company has purchased equipment uh, by paying $15,000 in cash down payment, if you will, and by signing a $60,000 loan, which is secured by a mortgage on the equipment itself. So if the company decides to stop repaying this loan, then the bank can take the equipment. That's what a mortgage does. It's a mortgage-backed security. It's a way of securing a loan. So the example of this loan, 60,000, is a 3-year loan, 12% stated interest, requiring 36 monthly payments of $1,993 per month for the 36 months. Uh, so we debit the equipment 75,000, we credit the cash down payment 15,000, and we credit notes payable 60,000 to record the asset being purchased by down payment of cash and by a loan. There are a couple of different forms of loans that we need to briefly talk about. Uh, and one of those is the difference between what we call a secured loan and an unsecured loan. When something is secured, it means it's backed by collateral. Okay. A mortgage is a form of a secured loan. Uh, a bond can sometimes be considered secure if it's backed by some type of collateral, but oftentimes they're not. So if the loan is backed by collateral, we call it secured. If it's not, we call it unsecured. Okay. Um, if it's unsecured, it's based off of like a credit score or some type of credit history. If it's secured, it's based off of the value of the asset. Okay. The loan or the bond can either be a term loan or term bond, or it could be serial term bonds. Here's what this means. The word serial means the same amount, serial, same number of payments over time. We call those serial payments. A serial payment is the same exact amount every month for a number of years. That's called a serial payment. A term payment means we only pay it like maybe once a year or simply at the end of the bond or the loan. A bond or loan can be convertible and callable. Let me explain this part. We can convert a bond to a loan. We can convert a loan to a bond. We can convert accounts payable to notes payable. We can convert accounts payable to a bond payable. Okay. That's what the word convertible means. I can change it into some other type of option. I could also change a bond into stock or a note into stock. Convertible, changeable, yeah. And callable. Callable means that the bond or the loan can be repaid before it matures. That's what callable means. And bonds and notes can be registered or what we call bearer. Bonds issued in the names and addresses of their holders are called registered bonds. Yeah, they're sitting on a register. They're registered somewhere. Yeah. The issuer of the bond makes the payments to the bondholder. The bonds payable to whoever holds them are called bearer bonds. Okay. The person who holds the bond is called the bearer. 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 That's the best way I can describe that. Okay, so just terms to know and the differences between the terms. One of the ratios that the bank computes before the bank decides to issue a note to a company is called the debt to equity ratio. In fact, this debt to equity ratio is also used on you before you take out a loan. All right, the bank will calculate the debt to equity ratio. Here we have an example for Nike and Under Armour and their debt to equity ratios. So for the debt to equity ratio, we simply take the total liabilities divided by the total equity. Uh, Anything above one is okay. Is okay. For me personally, I like this to be less than one, but that's because I'm very risk adverse. Uh, Anything, closer to one is good, reflects a little bit less riskiness. But if it's going up, like closer to 1.5, two, it's a little bit more risky. Yeah, because I prefer companies that have a little bit more equity than they do liabilities. But that's just Dr. B talking. Yeah. So just something to think about. So that's debt to equity. Uh, I'd like to further explain just a little bit about how bonds are priced out from a time horizon perspective, because I don't think that I mean, we did a pretty good job, but sometimes we're missing values and we need to be able to solve for those missing values. So sometimes we need to be able to compute the price of a bond. Uh, so we apply present value concepts in order to price up the bond. The market value of the bond, or the price of the bond, we can set this to be equal to present value in its future cash payments. So if we use a financial calculator, we can say that the market value of the price of the bond is equivalent to its present value. Uh, yeah. And we can say that the interest or discounted rate is used as the bond market rate. So here we have a situation, or an example, where we don't know what the issuing price is. So the issuing price of the bond is found by taking the present value of the bond's cash payments, discounted at the discounted rate. When we compute the present value, we work with semi-annual compounding periods because of the timeline that we just showed. The annual market rate in this example is 10.0331. We consider there to be semi-annual payments. And because of the semi-annual payments, we can say that the semi-annual payments are paid out at a rate of 5.0155. We got that 5.0155 by taking the 10.031, dividing it by 2, semi-annual payments. Uh, so first we find the present value, in this case $100,000, when it's paid at maturity. And then we find the present value of the series of the 4 semi-annual payments, which we know to be $4,000 each. Once we have that information, we can then use our present value index tables to locate the index amount. We take that index amount, or I'm sorry, factor, index factor, uh, And then once we have the index factor, we can uh, take the 5.0155, divide by the index factor, which will in turn give us uh, a stated rate. We take the stated rate, multiply that by the face value, and we get the present value of the bond. And we'll use that present value of the bond uh, to find the issued price. So that's how that works. It's kind of like solving for x and an algebraic equation, basically. Pretty straightforward overall. And we can also use these present value of annuity tables in order to allocate the present value factors if the bond is at a premium as well. So it works really the same way. Okay. Uh, we can also use this effect when it comes to amortization of a bond using the discount method. And here we have the discount method where the effective interest rate allocates the total bond interest expense over the life of the bond. And that's really how that part works. And we can apply this same process if the bond is at a premium for amortization purposes. Let's see, what else can I tell you about? The other thing I wanted to mention briefly is in regard to leases and pensions. When it comes to lease accounting, we first need to figure out who is in possession of the asset that is being leased. That will in turn tell us what kind of lease it is. It can either be considered an operating lease or a financing lease. And so there's a couple of different ways that we need to look at this. So a lease, as you know, is an agreement between the person that owns the asset and the person that is using the asset. Okay. For a classic example, if you live in an apartment or a house and you're renting, the owner of the property, the landlord, in this case, is the lessor. That's the person who owns the asset, which is the house or the apartment. And you would be considered the lessee, which is the person who is using the asset. So that is what constitutes a lease agreement. So the renters, pay the landlord cash payments in return for the right to use the asset. Yep. Some advantages of leasing, uh, like this: there's no upfront finance cost. Uh, we there's some tax deduction options for the landlord, and leases are classified as either operating or capital leases. So those are some simple advantages of a lease. There's a lease must have at least one of these five criterion if it's a finance lease. And let me explain what a finance lease is. Finance lease are typically long-term leases where uh, the leaseor leases the asset to the leasee, and the leasee has a right to purchase that asset at the end of the lease agreement. A couple of classic examples of this would be if you were to lease a car and that car, there was an option to buy the car at the end of the lease. We call that a finance lease. Um, Another classic example of that would be in the airline business. The airlines lease the airplanes from Boeing or Airbus. And so uh, those airplanes are owned by Boeing or Airbus and they're leased out by the airlines. The airlines have an option to purchase those airplanes from the manufacturers. And so that constitutes the airplanes as being finance leases. Yep. So that is the basis of a finance lease. The other type of lease is called an operating lease, which in simple terms means that there is no there is no asset that changes hands at the end of the lease, meaning the landlord still owns the property, the car company still owns the car. Uh, the operating lease basically says that the individual leasee has the right to use the asset as such and to return the asset in the same condition in which it was provided to the leasee. Examples of this, of course, include an apartment rental agreement. If you go to rent a car for a short term, uh, that's an operating lease. Some forms of equipment that are like this. I know that UDC engaged in a operating lease agreement for copier machines um, for some time. Those are all operating leases. Those assets are returned at the end of the lease agreement. Uh, when it comes to lease payments can be also amortized over time. We would take the lease payment minus any interest on a lease liability if it accrues. So it depends on the type of lease, but just wanted to point that out. The other thing I wanted to briefly touch on are long-term liabilities like pensions or retirement programs. Employee works for the company. Employee is able to retire from the company. Some employers pay out what we call a pension, which is a retirement benefit to those employees for the remainder of their life. Um, we call these defined benefit plans. Okay. If your company or organization offers a pension program, they're typically pretty decent because they live as long as the employee is alive after they've retired. Uh, these are a little less used today. A lot of employers no longer offer pensions, but some do. If your employer does offer one of these, you might want to consider taking advantage of it. Uh, I can tell you that these defined benefit plans for the company, we record this as a liability because it's something that we know we're going to have to pay out once the employee retires. They'll collect from this plan. So we've throughout the time the employer works for us, we record this benefit as a liability, and so it's reported on the balance sheet as a long-term liability. Uh, and it on the asset side, it's recorded as an asset if we overfund the plan, which is pretty rare these days. Most employers don't overfund. In fact, they usually underfund it. Uh, but that's how those types of benefits work. We simply record it as a liability and we pay it out over the life of the employee after retirement. That's how pensions work. And that, my friends, brings us to the end of our discussion today on long-term liabilities. Just to remind you, for Sunday night, you have your Chapter 14 quiz. I strongly encourage you to do that early, so that way you don't have to worry about something like that over Thanksgiving break. Just it's always best to knock out things early whenever you can, Don't want to stress yourself, especially on the weekends. Now, when we meet again, we're gonna the last time that we're gonna meet this semester is gonna be next Thursday, December the 4th. On December the 4th, we are going to cover two chapters, one on investments and the other one on the statement of cash flows. These are both very short chapters in nature, and yes, there are two separate quizzes, one for each. We also have in the final week of the class, I know, I'm sorry. One last LinkedIn Learning Certificate. This one's on financial statement analysis. In fact, I would encourage you to do this one a little bit early, just because I think it'll be beneficial for you to knock that out a little bit early. So, so for this week, you only have the one quiz. For next week, you have three things to do. So I'd really like you to try to knock out these three things a little bit earlier than planned. So that way you're not stressed out on the very last weekend of classes. Because then remember, after the last, day of classes, then you have your final exams and you know how that goes. So try to plan your time accordingly. I recommend that you work ahead. I think that they'll be beneficial for you. Are there any comments, questions, concerns about anything we've talked about tonight or anything that we have planned for the rest of the class? Anything at all? Now is your time to ask any type of questions that you might have. No, really? So surprised. You guys are so quiet tonight. Okay. Um, so thank you so much for your time today. I really appreciate it. If you need anything at all, you can email, call, set up office hours, whatever. Super. Thank you, Hannah. Yeah. Happy Thanksgiving to all of you. I hope you have an opportunity to spend time with your families and your friends and just enjoy, be thankful for the life that you have and for everything that you have in it. And enjoy your time. Now's the time to really be thankful for the things that we have in life. So, but thank you all so very much for your time today. I do appreciate it. If you need anything, feel free to reach out. And I hope you have a wonderful rest of your evening. Thank you so much.
Thanks, Professor.
My pleasure, Kia. Catch you later. Take care, y'all. Bye bye.
Thank you.
You're very welcome. Thank you.
Thank you, Professor.
Hey, my pleasure. Take care.
No, he's fall into the penalty area.